I'm Peter White. Welcome to the Inside Network. Welcome to the Inside Network INDepth series. I'm Peter White and my guest today is Bob Sahota from Revolution Asset Management. Bob, welcome.
Thanks, Peter.
Can you give us an overview of your organisation? Private debt, a lot of people don't necessarily understand that sector of the market.
So Australian private debt, and private debt in particular in this country, has really come about with a lot more interest lately as a result of a lot of people looking for an alternative to their normal fixed income allocations in their portfolios. So more of late, there's been a lot more said and read and discussed about the private debt markets than ever before in my 28-year career. Revolution Asset Management was established 2.5 years ago by myself and two co-founders, Dr. Simon Petrus and David Sager. We are really set about with a 60-year experience in private credit or private debt to be able to provide Australian high net worth family office and institutions with access to this unique asset class that's really starting to develop.
You mentioned private debt, private credit. Some people get confused. They are synonymous, interchangeable terms?
Very much so. And look, it's very forgivable to not understand the sector, because private debt is quite opaque in terms of what it means to different strategies. So private debt and private credit all mean effectively one thing. It's lending. So lending to a particular corporation or a particular investment where you are secured. In our case, we are secured in every case. And we derive the first ranking cash flows from that particular business to pay our debt before the equity gets its returns and dividends.
As a potential investor in private debt or private credit, what's the most important factor to look for?
There is one really important thing to bear in mind when you're talking about Australian private debt. It is really manager selection and having the credit discipline to say no to any particular deal that doesn't fit the criteria of what you promised your investors. Bearing in mind, unlike equities and other asset classes, you can only ever get your money back once you've lent it. So making sure that you get that money back and you get your interest period and coupons and distributions for that debt as you go along is most important. Therefore, manager selection and having that credit discipline with the manager you select is of paramount importance in private debt.
Has there been an increase in competition in the market for private debt in Australia and New Zealand?
There are certainly a lot more people talking about the sector in terms of private debt and new people setting up. I would say there's only really a handful, if less than half a dozen, that have got to any level of scale. And that's because of significant barriers to entry with skills and experience, but also the fact that capital raising in a fairly new asset class for a lot of people has been quite challenging for a lot of people. We're fortunate that we've actually got to scale in quite a short amount of time.
So I think the answer is that competition is increasing mildly. Has that increase in competition impacted returns, or how has it impacted returns?
Returns have still been remarkably high. That's because of this illiquidity premium that we demand in private debt. What do I mean by an illiquidity premium? For the same level of risk from public markets to private markets, for the same credit risk, you can earn not only the appropriate credit spread, but a premium above that because there's very little competition. This market is still dominated by banks, who are the predominant major players in private debt, but because of regulations that are impacted global banks, those banks are starting to step backwards in a number of areas where unregulated institutions such as Revolution Asset Management can take advantage of that position to be able to demand a better return for the same level of risk. So competition has slightly increased, but there's still a wonderful runway to get a very high risk-adjusted return.
No barrier to pleasant returns.
Well, the barrier is really on the capital raising side in this country. You've got asset consultants and other people who are gatekeepers who we really spend a long time to educate on the asset class and the opportunities. Thankfully, we're now getting to a point where we're getting a lot more traction in this current market.
With the heightened increase in volatility of equities, is there a chance that we could see private debt as a new value investing?
We certainly believe that would be the case. And it's really the volatility on the equity side is one catalyst. The other catalyst is as the COVID-19 pandemic has rolled across the world, the impact has been in developed markets that all rates have come down. So global rates are at all-time lows throughout the developed world. what do you do in terms of the defensive part of your allocation for this core income focus? Private debt is really one of the last bastions where you can still derive income for a defensive part of your allocation. So it's the volatility in equities, but also this keen focus of deriving income in an area where it's now devoid of income in fixed income land. So fixed income, we often say it's very much fixed, but no income anymore.
Well, speaking of fixed income, using that term, what happened in March in fixed income markets?
For somebody like me who's actually been involved in the markets for a long time, the parallels we drew from the experience in the global financial crisis, we found this time around in March, the drop and the dramatic slowdown in the economy was a lot faster this time. So we almost had a period where you had very much record levels in equities and other asset classes where they were all bid up by easy liquidity in the market. But then suddenly you had the pandemic arrive, and then everything sort of fell out of bed. And you had a lot of asset classes that went from being at all-time records to being in deep shock in record amount of time. I would say from that point on, the recovery has been dramatic as well. There's been a coordinated focus by global central banks to really put money in the pockets of the people most affected. In Australia, that's manifest in JobKeeper and keeping people employed and money in their pockets. That's actually led to quite a sharp recovery from those all-time lows in March.
Well, in those all-time lows in March, how did private debt perform?
Well, as you would expect in an asset class that is quite illiquid, and if you came into the portfolio or portfolio construction ahead of the COVID crisis in very good shape, and as I mentioned, having credit discipline. So at Revolution Asset Management, we always thought there would be some catalyst for some type of correction. We certainly didn't predict a pandemic being the catalyst for that, and nobody could have predicted that. But we knew after 28 years of unabated, no recession and fairly golden period that we were due for some sort of correction. So what did that mean for portfolio construction? We avoided pro-cyclical industries. We avoided hospitality, tourism, mining, in areas that were retail, that were really at the brunt of the cyclical market. What instead we focused on? Consumer staples, in healthcare, in infrastructure services, in mission critical software. Some of these are household names where we supported private equity acquisitions of companies like Arnott's Biscuits or MYOB or Genesis Care, the leading provider globally now of cancer treatment. All of these types of businesses and industries have fared extremely well through the COVID period, as they are fairly essential services or mission critical.
Do you think your prescience in this regard has been acknowledged or observed by your peers and by the industry and by commentators or not?
I think in time it will be. Right now, I think...
Under-realised at the moment?
Well, I think private debt is still something that people are grappling with, and I think part of having these sorts of education sessions is to educate people on the opportunity. I think it is underappreciated, but in the fullness of time, as you can say, well, you've been through the global financial crisis and traded through that period with very, very, very few losses and no defaults. And now with COVID-19, having had two portfolios that were all invested or mostly invested ahead of COVID, really you come out of it with a very good track record if you can say, well, it did what it was supposed to on the tin, which is give you stable income with security over very good quality companies and provide you income through these more volatile times.
Is there any specific change in the private debt market as a result of COVID-19 that you can point to, or is it more of a general situation?
I would say the biggest impact that COVID has brought to the market is the pendulum has swung more in favour of the lenders. So previous to COVID, it was very much the borrowers who had a lot of the power. They could demand lower yields in terms of what they could borrow at, so lower interest rates. They could demand probably more flexible terms and potentially more leverage. What the pendulum has now swung, so now we can demand probably lower leverage, better covenants in terms of the terms and conditions attached to these loans, but also importantly, we can derive a higher illiquidity premium as we've got a very finite resource, which is capital, patient capital, in a market where it's well demanded. So we see the advent of COVID actually increasing the risk-adjusted return for what we can derive for the same strategy pre-COVID.
Did the early release of the super, did that impact on your market at all?
In a very indirect way. So part of our strategy is to lend money to leading providers of non-bank lending. So be that groups like Pepper, Latitude, these non-bank lenders that operate in the markets. So whilst we don't directly issue mortgages or credit cards or personal loans or auto loans, we back these larger providers in the non-bank space in funding their business.
You're in the chain.
We're in the chain, we're relying on those guys making good loans. So what we've found is through the early release of superannuation, it's really provided a buffer for some of the lenders, for some of those borrowers who probably were under stress, to be able to increase their cash reserves to be able to make those payments on their credit cards or personal loans or any of those obligations that they have, so that the COVID hardships have actually been lower.
So it's actually helped the security of your loans, really.
It's definitely helped the serviceability and being able to provide people with a bit of buffer through a period where they necessarily might not have had the ready cash to get through the pandemic.
Can you provide some insight into the best monthly returns that you've had in your history?
We always aim for a pretty stable and boring type return, because in credit, boring is good. Boring means that you can get your money back and you can get your interest as and when it's due. But in May this year, we had a situation where we had a number of secondary market opportunities where we could seize upon probably more forced sellers rather than distressed assets. So some other funds who had offered more generous liquidity terms suddenly had those liquidity start to really be called upon. So as a result, they had to liquidate the best part of their portfolios, typically very high quality pieces of paper. So inherently nothing wrong with the investment, but needed liquidity very quickly. We were able, with our patient capital that we have with Revolution Asset Management in our funds, be able to take advantage of that and bid into those and purchase those at significant discounts, and then be able to realize them and sell those, which we typically don't trade in our strategy, but trade out of those in a number of weeks to be able to realize significant gains. So our best monthly performance to date was in May this year.
Do you want to put a number on that?
The return on our fund number 2 was 1.17% for the month.
Now, speaking of fund number 2, investors, they can't lend to you on specific assets. It's only via your organised funds. Is that correct?
Yes, we're up to our second fund in terms of a pooled vehicle. It's not relevant for or appropriate for retail, pure retail. It's more for the wholesale market, more the sophisticated high net worth, family office, and then also larger institutional investors, of which we've got a spectrum of all of those in both of our funds.
What's the minimum contribution and what are the barriers to investors?
So the minimum subscription into our fund would be $100,000. There is no maximum, and there's 2 different vehicles in terms of being able to access. One's a wholesale feeder vehicle, and then the master fund for larger institutional investors.
Some people have speculated or postulated that private debt really is entering a golden period. I guess you'd agree with that, would you?
Spent a long time trying to be an overnight success in this market. So I'd feel like suddenly a lot of people are starting to sit up and take notice on what private debt can offer in terms of their overall allocation. It is a very established asset class, I might add, in other jurisdictions like the US and Europe. Coming out of the global financial crisis, those banks operating in those jurisdictions had to reduce risk-weighted assets and really bring in private debt investors alongside them in bringing them into those sorts of markets. So that, having the 10-year track record, has really become a very established market. We see just Australia being behind that. And in fact, New Zealand is also a very interesting area that we invest in as part of our strategy that separates us and differentiates us from our peers, that is really underutilized in terms of the opportunity set, but it will become very much established like it is in other parts of the world.
Once we're through this COVID malaise, will the gains that your industry's made and the maturity it's achieved, will they be lasting, or will you be on the back foot again once we get through the pandemic?
We feel as though there's 24 to 28 billion of market opportunities in the asset classes that we focus on. You compare and contrast that with really 6 managers that operate like Revolution Asset Management in the market. So we see the market opportunity being one that is not just a flash in the pan or one that's available for the next couple of years. It is one that I've been investing in for the best part of 15 years. And the reason why I've established this firm at Revolution Asset Management is because we see the future being extremely bright in this asset class and one that we can really add value for investors.
Bob Sahota, thanks for talking to Inside Network.
Thank you very much, Peter.